Hello everyone, thanks so much for joining for another video. Today, as I've just introduced the cash flow statement, I want to make a video on ratios. I recorded a few videos on ratios, especially solvency, liquidity, profitability already, but that's when we looked at the income statement, where you can take a lot of numbers as well to make sense of a company's performance. But now let's look from a cash flow perspective. So when we look at cash flow, we can take a look at two areas. One is around profitability, around cash flow performance. So we call those performance ratios. And the second has to do with solvency, and we call it coverage ratios. We talked about solvency earlier when introducing the balance sheet, because to identify a company's solvency risk, you can look at debt over assets, debt over equity. You can use balance sheet items as well to see, okay, what is the capital structure? If a company has more debt, it needs to pay higher interest. So you can look at solvency from a balance sheet perspective, but in more detail, you can look at coverage or solvency from a cash flow perspective. That's what we are doing here. Same applies for performance ratios. You can look at some of those from an EBIT, from a net income perspective, derived from income statement. But here what we do, we look from a cash flow perspective. Yeah, so the first formula is cash flow to revenue. Very easy, CFO, cash flow from operating, divided by net revenue. Net revenue is basically, when we say net revenue, it is the revenue or the cash that we have received from customers. So here, because we are talking about the cash flow statement, what we are doing here is trying to use the cash item. What does it measure? It's basically the cash, the operating cash generated per $1 of revenue. So if you put $100 net revenue in, how much CFO do you get out? Yeah, that's what it tells you. Another one is cash return on assets, which is again CFO divided average total assets. Again, how much operating cash is generated per every dollar of your asset that you have put in. Here again, because you're taking a balance sheet item, here balance sheet, you need to take the average between two balance sheet dates. Cash return on equity, exactly the same. CFO divided by shareholders' equity. It's again how much operating cash is generated per every dollar the owner has invested. Cash to income. CFO over operating income, again, cash generating ability of operations. You can also do cash flow per share, which is CFO minus preferred dividends divided by number of common shares. Here you need to deduct preferred dividends because you want to put in relation what cash has been generated per each common share. If you would take the CFO number only, it would be overestimated because this number is not generated for each number of common shares, because it also includes what is available for preferred shareholders. So you need to deduct this part to basically have a direct relation to common shares. Yeah, so these are some formulas, performance ratio. Sometimes what we do, and we do it many times in finance whenever we talk about CFO, sometimes we use EBITDA as an equivalent or an approximation. Yeah, for sure, CFO is more detailed because it includes additional adjustments, but many times when we look at the performance, we look at EBITDA measures as well. If we look at coverage ratios, for example, debt coverage, CFO over total debt, talks about financial risk, financial leverage. We talked about this earlier. You can use balance sheet items as well to look at, okay, debt over the entire liabilities plus shareholders' equity side. Interest coverage, which CFO plus interest paid plus taxes paid divided by interest paid. Interest coverage, sometimes we use, instead of this figure, we use kind of EBIT or EBITDA figure as well. It is basically another ratio to tell you the company's ability to meet interest obligations, or how much cash do you have available to pay your interest. Then reinvestment, another ratio, CFO divided cash paid for long-term assets. Okay, see the ability to acquire assets with operating cash. How much cash do you have to invest in your long-term assets without the need to raise additional capital? And then debt payment, CFO divided cash paid for long-term debt repayment, ability to pay debt with operating cash flow. Okay, and then we have two more. Dividend payment, CFO that's paid, and last one, investing and financing, CFO over cash outflows for investing and financing activities. Good. So in general, if you look at these, and with all those ratios, always look at which numbers in the numerator and which numbers in the denominator, because this can change and there are many ratios out there. In general, performance ratios. If your CFO is high, it's good, because it means $1 of revenue generates a lot of CFO. $1 of asset generates a lot of CFO, $1 of shareholders' equity generates a lot of CFO, and so on. So here, if you look at this, it's good, because it means you have more cash flow generated with whatever you have put into, be it net revenue, total sales, shareholders' equity. If you look at the coverage ratios, here a high number is good as well, because it says coverage, how much cash flow from operations do you have to cover whatever you're looking at? How much CFO do you have available to cover total debt? How much CFO do you have available to cover your interests that you need to pay? How much CFO do you have available to reinvest in your long-term assets? How much CFO do you have available to pay your long-term repayment? The lower the number, the less CFO is available and the more critical it is, and the higher the solvency issues of that company. Good. Thank you so much for listening. See you later. Bye bye.